Okay, I had a couple questions from people going through CFP exam prep about the same topic. And it is something we went through in course 234 as well. So if you want a more detailed review of this, you'll find this at about the 2-hour mark on day 2 of course 234 on those webinars. But bonds are not always issued with consistent par values. I hope you can read this. I have bond A here issued with a $5,000 par value. So issued at a relatively high par value with a 4.3% coupon rate. And then bond B, a different bond issued by maybe the same company at a different time, issued by a different company, who knows, but a different bond anyways, issued with a $1,000 par value and a 4.5% coupon rate. So this leads us to a challenge. If interest rates are 5.1% today, how do we know which bond is better for our particular circumstance? So we have to have some way to compare the two bonds. And the way that we do that is we create a uniform way of expressing the bond price. And the bond price will be based on every $100 of par value. So we're going to basically treat this bond as if it has a $100 par value. We're going to treat this bond as well as if it has a $100 par value. Now in an exam question, you'll typically see it on, especially from FPSC, you'll typically see the bond expressed with this full price, with the full par value, but then the price as if you would see it or how you would see it represented on the bond tables. So this bond A, the price for this bond would be determined as follows. We would just go through our same calculations as we will always do for any TVM problem. It's just going to be a matter of bonds always on end, of course. So bonds always 2 periods per year. With this particular bond, we'll give it 8 years to maturity. We'll say the same for this one, just so that we're doing a little bit of apples to apples comparison. So we'll give this one 8 years to maturity. Of course, if we're solving for a callable bond, we would solve based on yield to call, but in this case, 8 years to maturity. Interest rates, well, today we can see an interest rate of 5.1%, so we'll plug in 5.1 here. Present value, so our present value is going to be what we're solving for our price. Payment, the payment is going to be based on a 4.3% coupon, but if we're using a par value of $100, that is, we're going to bring everything into the same level, or everything to the same point, a common point of understanding. So if we have a $100 par value, we would take that times 4.3%, which of course gives us $4.30, but we know it's only paid on a semi-annual basis. So the payment here will be $2.15. So what you would actually see, this bond issued with a $5,000 par value, 4.3% coupon rate, with 8 years to maturity, this is how you would solve for the price of that particular bond. So we can just go through and input all those values into the calculator. And solve for our present value, and you'll get a value of $94.79.8. And this is normally what you'll see is, I know you can't spend 0.8 of a cent, but bond prices will normally be represented to 3 decimal places. So this first bond, my bond A, has a price of $94.79.8. That would be its price if we're comparing it to other bonds. Now we can solve for bond B, and that will give us, once we solve for bond B, we have a method to compare the two bonds even though they have dissimilar par values. So we haven't changed everything here. PYR and times PYR are still the same. I guess IYR is still the same. I didn't need to erase it. We're still solving for the present value. My payment is a little bit different now. My payment will be based on a 4.5% coupon rate. So that will be, of course, $4.50 divided by 2 would be $2.25 of payment. And once again, I'm using that same $100 par value. It makes everything uniform with respect to that bond. Once I know all those values, I can just go through and solve. And that will give me now some uniformity and apples-to-apples comparison with my bond. So in this case, my present value comes to $96.09 and 9/10 of a cent. That will be my present value, and of course it'll come out as a negative. You have to spend that money to get that bond. So this is how we would arrive at the prices of bonds. And if you look at an actual bond table, if you were an actual bond purchaser going to buy bonds, this is exactly how you would see them represented. You would see prices of 94.798 for bond A and 96.099 for bond B. So I hope that helps get to an understanding of bond pricing. I know that this is sometimes a little bit confusing, and especially with how you'll see the questions worded, because an exam question asking about this bond will give you a $5,000 par value and a price of just under $95. A question asking about this bond will give you a $1,000 par value and a price of just over $96. But this now allows me to compare two bonds with dissimilar par values, but still to have this apples-to-apples comparison. Okay, thanks very much.